Well, the Bank of Canada almost shocked the world again. Not really, because most economists, as of last week's job numbers, came in and said we are going to see a 50 basis point, 0.5% rate cut, and they did it. So December 11th, 2024 is going to go down as the second time in a row that the Bank of Canada has opted to provide a 0.5% rate relief, which is amazing news for all those people out there who are rejoicing, who have variable rates, home equity lines of credit, or any other line of credit or product that's based on prime. Essentially, what's going to happen is prime will go down by 0.5%. Most banks will see that number go from 5.95 down to 5.45. Not to confuse that with the overnight rate that went down from 3.75 to 3.25. Good old Trudeau last time confused everybody, saying that that was the actual interest rate. So let's talk about why this happened and what this could mean for the fixed rate market and variable rates going forward. But first, let's get into some of the stats that you need to know as to why the Bank of Canada made this decision. And we'll talk about, of course, later in the video, my predictions and a sneaky one about what could happen in the marketplace. Now, one of the biggest reasons the BOC made this decision, among many reasons, was the poor unemployment. Essentially, last Friday, the jobs report came out and showed, not surprisingly, terrible results. Unemployment is up in the country despite having a gain in jobs, mostly in the public sector. The private sector has been suffering, and more people than have been in a long time are actively unemployed. Surprisingly, there's a huge group of people in the youth, younger folks era right now that are not actively employed or gainfully employed at this point right now. Now, this is the fifth BOC rate drop that we've actually seen now, going back to earlier this year. 5 in a row, which is quite significant. Remember, we started at an overnight rate of 5%. Now we're sitting here at 3.25%. The good news for those folks in variable rate mortgages right now is if you have an adjustable rate payment, some of those people saw payment increases in the thousands of dollars. They're seeing that reverse effect happening. Now, when this goes down, basically every 0.5% is about $30 per 100 grand, depending on your amortization. So it can have a huge impact on the day-to-day budget of many families. If you think about it, that's another $150 on a $500,000 mortgage worth of monthly payments that people are seeing. But the other factor is home equity lines of credit. Home equity lines of credit have been blowing up over the last few months, as shown by evidence of how many people have been using these lines of credit, whether it be for investments or my assumption, which is probably consolidating other high interest debt. This is going to have some relief for those folks who have home equity lines of credit because, of course, they're relying on the overnight rate, in effect, prime, to be able to set up those interest payments. Now, the interesting thing is, on the backs of the BOC making this decision, the bond yields did almost the opposite of what many people affected. As a reminder, the bond yields mostly affect fixed rate mortgages. And so what happened today was pretty interesting because the bonds basically went up 0.5 today, which means that they did the opposite of what a lot of people affect. Now, this is on the backs of a lot of US information. Remember, the Canadian bond markets mostly watch what happens in the US markets, and they react directly and proportionately to that. So I think a lot of Canadian consumers are going to get really confused because a lot of people out there still believe that when the Bank of Canada drops rates, that fixed rates come down as well. And that is just not the case. Since the bottoms early in September, the bond markets have rallied pretty significantly, and we saw them rally all the way up until November when the election occurred, and then slowly work their way back down a little bit here in December. Now, the last few weeks have remained sticky, and we've seen things really hang out where they are. So the banks themselves are not likely to provide any kind of discounts on fixed rates, at least not for any time, and maybe not at all. And that's on the backs of many economists out there who are suggesting that fixed rates themselves might be, if not already, at the bottom. So where does the Bank of Canada actually go from here? A lot of people are asking this question. Now, Tiff Macklem said, we're done with the jumbo rate cuts. From here on out, we're most likely going to be doing slow, steady increases, which doesn't necessarily mean we won't continue to see the BOC reduce interest rates, but it does mean that the 50-point rate drops are probably not going to be seen again unless there is something extreme that happens, like, let's say, a tariff from the US. Now, he didn't comment heavily on the tariff, but he did mention that if this happens, it could have a significant impact on the Canadian economy, which means the BOC would have to react at that time. Without making those assumptions, at this point right now, again, the BOC is proposing that we see things go down by about 0.25%. Where do the rates actually end up is anyone's guess. If you've looked at some of the revisions lately, a few of the major banks, namely TD and CIBC, suggested that we'll see the BOC end up with rates coming down another potential 1% off of where they are today. But more of the conservative economists are suggesting that the BOC will end up at an overnight rate somewhere between 2.5% to 2.75%. which means about a half to 0.75% lower today. Those folks who have variable rate mortgage today could see their rates in the low 4s or even in the 3s if that were to happen. Now, a question a lot of people are asking is, well, if my renewal is coming up pretty quickly here or I have a fixed rate, does it make sense for me to consider a variable rate in this market? Well, now with the 0.5% rate drop, you're going to see fixed rates and variable rates almost directly a proportion of each other. But what you could see happen very quickly is that many of the banks are going to start clawing back on the discounts they offer off of prime, which means instead of getting a great 0.55 or 0.65% discount on an uninsured mortgage or 0.9 on an insured mortgage, they can start pulling back and saying, we're only going to give you 0.35 or 0.65 off of prime as they see those variable rates go down. In fact, we've already seen some of the major banks reduce the amount of discounts that they've been providing. As we look forward, I think one of the biggest impacts that no one is talking about is something I mentioned earlier in this particular video, which is the home equity lines of credit. And do we see more investors come back into the marketplace? It's an underutilized tool for a lot of people, and when we see the cost of borrowing go down, it can add stimulus to the environment. There's no doubt that today's decision is going to have an impact in concert with the December 15th guideline and rule changes. January is shaping up to be a hot month in real estate, and the question that most people are asking, is it just January or does it sustain long term? What are your thoughts on today's Bank of Canada decision? Did they make the right call? Do you see rates going down another 0.5% or even more, 1 or 1.5%? If you like this video, hit that subscribe and leave me a comment below. Thanks, guys.